Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Russell Rhoads, Associate Clinical Professor of Finance at Indiana University. He joins me to discuss what is indicating that traders are on edge and a reaction to bad news could potentially be headline grabbing. Russell, it's great to see you as always. Welcome back to Trade Talks. And when the VIX is up, S&P 500 is up, and some other indicators, it means that traders are on edge.
Yeah, and not just VIX in the S&P 500, which I wrote up a little bit on this weekend. And of course, you get pushback when you take a directional opinion on the market. But not only is that relationship kind of disconnecting from what we're used to, which means they're both moving in the same direction. If you take a look at the implied volatility of Nasdaq 100 options, if you draw a chart out, going back to about mid-December, that's when the implied volatility of NDX options basically bottomed out. And since then, we've made several new highs in the Nasdaq 100. And typically, what you expect is for implied volatility of broad-based index options to maybe hit a new low or at least test some lows when we hit new highs, and that is not what has been going on. They've both been trending in the same direction. I just got back from a conference where if we drank every time we heard the word fragility with respect to the equity markets, we would not have made it past lunch. So I do think there's a lot of concern out there with respect to the direction of equities, just waiting to get the piece of news that maybe makes things turn to the downside.
Right. And that makes sense, right? We're coming out of earnings season when you're in that earnings vacuum, if you will, where the market is so hyper-focused on what the Fed is doing, inflation, and the larger macro picture. That's when we start to hear a little bit more negativity. Earnings season, for all intents and purposes, was pretty decent, right? The companies where we expected big news on earnings and did well with their quarters and did well with guidance, that's what was moving the market. And that's sort of how it played out. But once you come within that vacuum of earnings, now everyone's focused on climbing that wall of worry again.
Yeah, and Powell's going to do us a favor, although I don't think he'll say anything because he is talking and is speaking in front of Congress this week. Those are always kind of interesting when you pick up on the frustration of the Fed chair with some of the silly questions that they get. I doubt he's going to give us a whole lot of insight. So what we've got this week is the last day of this week is the February non-farm payrolls. Non-farm payrolls is always the first look into economic activity in the previous month. And what I'll be paying the closest attention to with non-farm payrolls is there anything that appears to be inflationary in there? And salaries have been catching up with it, with the higher cost of living. And I think it showed up a bit in the last month's number. I think we might see more of that this time. And I'd be a bit concerned being too long going into the number on Friday.
Do you think we're starting to see any uncertainty around elections creep up in the numbers yet, or is it too early within the election year? And then also, do you think investors and traders, they're concerned about, our fiscal policy and the amount of debt that the federal government has? Do you think part of the elevated indicators that you're seeing has to do with any of those factors yet?
I think some of the macro issues and the amount of debt that we continue to take on, I saw a stat earlier today and I haven't had a chance to verify it, but apparently we're adding $1 trillion to our debt every 100 days. That's pretty frightening. I remember a time when I didn't even know what came after $1 billion. And now we're constantly talking about trillions of dollars. So I think it's more, I don't think the market is too fixated on the election yet. You can see when you look at the implied volatility of options that expire just after the election, that it is elevated and there's risk being priced in, but I think it's non-specific risk. Personally, I'll be, and I think a lot of people agree with this one, I'd be really surprised if it's Biden versus Trump. They're both kind of old. They both have, I'm not going to get into too many of the issues, but it's very possible that we're going to see one or two different people on the ticket. And I actually think the market might like a different candidate than either of those staying totally out of it politically. I don't want to hear any hate mail about that. I'm talking about both of them equally here. But now you do see it in the farther dated options. We used to not see that, but the surprise election of Trump, 2 cycles ago or 8 years ago, that one has changed the way that the option market does behave around I started to say earnings announcements around presidential elections, just because used to be we always kind of had a pretty good idea as to who was going to win. In fact, I think Time Magazine put a Madam President cover out the week before the election, and they got to eat a little bit of crow on that one. So there's uncertainty, but I don't think it's specific toward either candidate. It's just more uncertainty around the election, but also I think nearer term elevated implied volatility is not election related. But I think you have a really good point there with respect to the lack of fiscal restraint that we have out of Congress in spending. It's just something is going to have to give. And when something gives, it's not going to be the best for business and the economy.
All right, Russell, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.